Hello, friends. Today we're diving into something pretty big in the world of money and markets. Imagine your money in a safe place, but that place is slowly losing value. That's what's happening in a certain kind of investment called as Treasury Bonds. So here's the scoop. Since March 2020, the value of some of these bonds, especially the ones that are locked in for 10 years or more, has gone down by a whooping 46%. And if you talk about the 30-year bond, it's fallen by almost 50%. To put that into perspective, it's like some of the big market crashes we've seen before, after the tech bubble burst and the big 2008 financial crisis. This is a bit of red alert for the money world, and it makes us all wonder, what's the next step here? How do we move forward when the financial ground beneath us seems shaky? Stick around as we journey through this together, figuring out what might come next on this bumpy financial road ahead. Now, how did we arrive at this pivotal financial moment? Let's delve into the history of steadily rising bond prices and uncover the triggers behind the current market shift. Now picture this, for about 40 years since the 1980s, bond prices were like a balloon, slowly going up and up. But recently, things have started to shift, and it's a bit like the balloon is beginning to lose air. The prices aren't climbing like they used to, and this change is due to a bunch of different things happening around the world with how governments manage their money. Governments, like our own, have been borrowing more money to manage their budgets, and they do this by issuing something called as bonds. But on the flip side, the demand for these bonds is going down for several reasons, like the Federal Reserve buying fewer of them and shifts in the investment strategies in big players like China and Japan. All these happenings are like different breezes steering our balloon into new directions, causing bond prices to stop their steady rise. Now, there's also a bit of dance happening between the Federal Reserve policies, bond yields, inflation rates, and how our economy grows. When the Federal Reserve acts tough or hawkish to control inflation by potentially raising interest rates, it causes a ripple effect. Borrowing costs go up, investments might slow down, the economy grows a bit slower, and this in turn impacts how the Federal Reserve will act in the future. It's like a domino effect where one action sets off a whole chain of events. It's a lot, right? But understanding these moves and shakes in the financial world is crucial because it affects all of us in one way or another. Stick around as we'll now explore what this all means for our wallets and for our future. Venturing into this uncharted realms of the bond market, we spotlight another key player, and that's oil. Let's explore how the upheavals in the bond yields reverberate through the oil markets. Imagine a seesaw. On one end, you've got oil prices, and on the other, all things happening to our economy. They affect each other, tipping back and forth. Not too long ago, folks in the trading world were pretty upbeat, thinking that even with interest rates climbing, our economy would stay strong and demand for oil would remain high, keeping those prices up too. But then came a bit of a curveball. Those bond yields we talked about earlier sprang up quicker than most had their eyes set on. This sudden jump spooked the market, causing a stir and a dash of panic, especially among traders dealing with oil. Now here's a scoop. With bond yields going up so quickly, traders got a little jittery, worrying that a recession might be sneaking up around the corner. A recession means less demand for oil as economies slow down. So what do traders do then? They start selling in order to protect their profits, just in case that feared recession does show its face. This bit of our story just goes to show how everything in our financial world is interlinked. A jolt in one area, like a sudden spike in bond yields, can send ripple effects through others like the oil trading sector. Is a recession on the horizon, or will we steer clear of it? That's the big question hanging over us. So stay tuned as we continue to journey through these intriguing financial twists and turns, making it all a bit easier to grasp together. Shaken by bond yield fluctuations, the oil market prompts scrutiny into the policies and decisions behind these economic shifts. Let's delve into the government's past financial strategies and spending habits to understand potential upcoming financial disturbances. Now cast your minds back a few decades to the 70s and 80s, a time when interest rates were sky high, and compare it to our current scene. Sure, there are some similarities, but also stark contrasts. Today, there's a bit of wariness in the air regarding the massive spending programs the governments rolled out during the past administrations, especially during the unexpected twists and turns brought on by the COVID-19 pandemic. The skeptics amongst us might raise an eyebrow at how sustainable all the spending is. The pandemic surely shook our financial world, but it didn't entirely reset our spending habits and fiscal strategies as many thought it might. So the question hanging in the air is there really another financial shakeup lurking around the corner? There's a bit of wisdom saying that major financial reforms often come riding on the coattails of crisis. With that in mind, our journey today nudges us to ponder upon the careful steps needed in managing our economy and the cautious path that lies ahead regarding government policies. In analyzing government spending, it's vital to understand how banks navigate turbulent financial seas, but how do reported losses in bank bond portfolios truly impact and relate to government financial strategies. Now, in order to gain a deeper understanding of bond markets, let's shift gears and look at US banks and some seemingly alarming numbers popping up regarding their bond portfolios. According to numerous reports, we've got a number floating around, and that's $400 billion of losses on bond portfolios of US banks. That's a big number, right? But let's pull back the curtain a little and understand what this really means. First off, it's crucial to know that these losses aren't quite what they might seem like. They aren't cash draining out of the banks, but reflect a mark-to-market value, which essentially means it's the value of these bonds in the current market scenario. Let's talk a bit about a strategy called as hold to maturity. Imagine you buy a bond and decide to hold on to it until it's due or matures. Even if its market price bobbles up and down in the meantime, but as long as you hold on to it and the issuer does not default, you'll get your initial investment back when it matures. Now here's where the crux is. Banks, insurance companies, and pension funds usually aim to hold their bonds till maturity. Thus, they should get back the full investment, ignoring the market's temporary ups and downs. But there's a big but. If for some reason they need to sell these bonds before maturity, maybe due to the need for quick cash or other pressures, and the market value of these bonds are down, that's when they might have to swallow big losses. In essence, this financial chat shines a light on the intricate mechanics of the bond markets, highlighting how losses might not actually mean a direct financial hit unless these hefty entities find themselves in a pinch and have to sell their bonds off prematurely. The mechanics of losses in bond portfolios led us to explore management strategies next. With the volatile bond market, how do banks and private equity firms navigate through these ensuing challenges? You see, managing a bond portfolio for a bank can be a tricky balancing act to achieve. At the heart of it, banks deal with something known as mark-to-market valuation for their bonds. Now, this doesn't mean real tangible losses, but represents how much those bonds are worth in the current market. Think of it like this. If the bank keeps holding on to the bond until it matures without being nudged to sell it off early, the ups and the downs of the market values don't actually touch the bank's wallet. Those losses remain on paper unless a bond is sold before it matures. Often a move made during a liquidity crisis when a bank needs to ensure it has enough cash in hand. But here's where things get a little interesting. Different banks have different portfolios and financial standings, which means means they can handle risks and potential cash crises in different ways. Some, due to their specific holdings or financial setups, might be in a bit of a precarious position, especially when market values are bouncing around a lot. In layman's terms, what this means is that the big financial principles stay the same. Each bank's unique circumstances demand its own strategy through its economic journey. And in moments where the financial climate is a bit intense, smaller or perhaps less stable entities might face storms that require smart and sometimes bold financial moves. We've seen how banks manage the impact of rising interest rates. Now let's shift our attention to private equity firms, or PE for short. PE firms are often known for buying companies using a lot of debt. They put that debt on the company they buy, expecting to manage their cost. But here's the catch. When interest rates are going up, this gets a little trickier. Private equity firms rely on a metric called as the interest coverage ratio. It's basically comparing a company's profit to how much it's paying in interest. When interest costs go up, this ratio can start to look a bit worrisome, signaling more risk. PE firms now have a tough choice. They can stick with the plan, use lots of debt, and face possibly bigger and more frequent losses. Or they can decide to use less debt, which means spending more of their own cash and making deals more expensive or reducing their purchasing or buying power. So PE firms are, in fact, in a limbo. It's a tough call and one that could shape this sector in the months to come. Navigating through turbulent financial waters, banks and private equity firms influence a broader corporate landscape. Let's explore how rising yields, especially on junk bonds, impact financially precarious companies. Finally, we'll now see how the winds of change brought by rising interest rates are impacting the corporate bond market. When we talk about corporate bonds, what we're really discussing is how much it costs a company to borrow money. Recently, yields, or the returns investors can expect on US junk bonds, which are kind of like loans to companies that are seen as riskier bets, have jumped from roughly 8.5% in March 2023 to about 9.2% in October 2023. That's a big leap, and it means borrowing money for these companies just got pricier. Then there's also a talk about zombie companies. These firms have been just barely scraping by financially since the 2008 crisis and have not been truly vibrant and financially healthy. With borrowing now becoming more expensive, these zombies might face a reckoning, forced to face their financial struggles head-on in this tougher borrowing environment. This could spell trouble for these firms and puts a spotlight on how rising costs in a broader economy can trickle down, affecting various sectors and businesses in potentially unexpected ways. Exploring rising yields and strategic bond management reveals the interconnectedness of the financial ecosystem. Let's step back to understand how these elements intertwine within the larger economic tapestry shaping our financial future. In the evolving tide of the financial world, the diminishing value of Treasury bonds and rising bond yields have sparked concerns echoing historic market crashes. This intricate dance between federal policies, global shifts, and oil prices undeniably affects our wallets and our futures. US banks navigating through strategic bond management face a careful act of balancing amidst the fluctuating values, while private equity firms grapple with the implications of rising interest costs. This economic panorama also points towards a potential reckoning for zombie companies struggling in a tougher borrowing environment. Well friends, how do you foresee the unfolding of these economic events? Share your thoughts in the comment section below. If you enjoyed this exploration, please like, share and join us on future journeys, and subscribe and hit the bell icon to never miss an update from us. Together, let's continue to navigate these financial seas. Stay savvy and see you all in the next video. Bye for now.